5. Shocking money. Truths they don't teach in school. Good day, fellow frugal hunter. Are you sick and weary of feeling as if you were misinformed by your financial education? You're at the proper spot if that's the case. We shall discover today the undiscovered financial knowledge, pearls that were not taught in school. Yes, prepare to learn the 5 money secrets that aren't taught in school. We're delving deeply into personal finance to give you the tools you need to succeed, from clever investment techniques to clever budgeting tips. We have something for everyone, whether you're a seasoned pro trying to step up your money game or a fresh graduate navigating the real world. So, grab a cup of coffee, settle down, and let's start this empowering trip. Let's get started. Number 1, money loses value over time. For decades, economic theory has been firmly rooted in the idea that money is a store of value. People have believed for millennia that money is something that appreciates in value over time and can be saved and invested for the future. But inflation, a persistent increase in the average level of prices for goods and services, fundamentally calls into question this presumption. The same amount of money will buy you less in the future than it does now because it steadily reduces the buying power of money. For instance, over time, the price of necessities like food, shelter, and transportation keeps rising. A dozen eggs cost $2.86 in 2022. After just a year, the price rose by 14% to $3.27. Your dollar will not go as far in the future as it does today if this trend continues. However, why does this occur? The core processes of inflation, which are mostly related to the money supply under central bank supervision, hold the key to the solution. There is more money in circulation in the economy when governments issue more money or lower interest rates, which lowers the value of each unit of currency. Personal wealth is significantly impacted by this. A regular savings account does not provide inflation protection. Even while the nominal value of your savings may rise modestly over time, its buying power will eventually decline since interest generated on saves is often considerably below the rate of inflation. Investing becomes necessary to offset this. Investment vehicles that often beat inflation, such as stocks, real estate, and commodities, are essential for preserving and increasing wealth. The actual worth of your money decreases, and you miss out on the chance to accumulate long-term wealth if you don't make investments that exceed inflation. Number 2. Saving makes you poor. Many of us learn early on that the secret to financial stability is saving money. Savings is vital, but if done in a vacuum without taking inflation or growth prospects into account, it may also be a wealth killer. Putting money into a bank account, the most popular way to save money, often results in a meager return that is sometimes much lower than the rate of inflation. In other words, when living expenses increase, the money you have saved and earned becomes less valuable. Think about this. Although the money you put away in a savings account years ago may have looked like a wise decision at the time, the wealth you believed you were building has actually decreased as inflation reduces your buying power. A savings account doesn't provide much growth, and it can't fight inflation unless it's earning a high interest rate, which is uncommon. For example, you may get 1% interest per year from a savings account, but your actual returns are negative if inflation is 3% or more. Number 3, central banks control everything. Having cash in your hands can make you feel like you've got a handle on your money situation. But honestly, central banks are really the ones calling the shots when it comes to the economy. They manage the money supply, the flow of credit, and pretty much have a say in every part of economic life. Central banks, like the Federal Reserve in the US, the European Central Bank, or the Bank of England, manage monetary policy using tools like interest rates, reserve requirements, and open market operations. Central banks set interest rates, which basically decides how much it costs to borrow money. When interest rates go down, it makes borrowing and spending more appealing, which can help boost the economy. But, when interest rates go up, it makes borrowing pricier and usually slows things down a bit in the economy. Central banks play around with credit and liquidity to keep inflation in check, smooth out the ups and downs of the economy, and try to avoid any major economic meltdowns or crazy inflation spikes. Also, central banks are in charge of making money. When the economy is struggling, they can just print money to boost things up, making cash flow better and helping growth happen. But You know, this whole money-making thing can also cause inflation, especially if there's just way too much cash floating around without enough stuff to buy. Number 4, the difference between credit and cash. At first look, cash and credit might appear to do the same thing. They both let you buy stuff and pay for what you need. But knowing the difference between the two is super important, especially for building wealth over the long haul. Cash is super handy for everyday purchases and gives you quick access to money. It doesn't tie you down with future obligations or liabilities. And you get complete control over your finances right when you make the transaction. Dot credit lets you use other people's cash to your advantage. If you use credit the right way, it can really help you grow. It lets you make bigger investments and buy things even when you don't have the cash on hand right away. Credit isn't just about the cash you take out. It's all about your financial vibe, the confidence that people have in you to pay back what you owe. Keeping your credit in good shape is super important. It helps you snag better loan deals, higher limits, and lets you invest without just depending on your cash flow right now. Number 5, money is tied to value. Getting how money connects to value is key to figuring out how wealth is built. Value is what keeps the economy moving. It's the foundation of supply and demand. Wealth isn't just about stacking up cash, it's really about making something valuable that people want to buy. Cash is how we trade value. The richest folks are the ones who bring a ton of value to the table and make sure what they offer really hits the mark for everyone out there. Making value happen isn't just a one-off thing, it's something that keeps going. Successful entrepreneurs don't just whip up a product and call it a day. They keep innovating and adjusting to what consumers want as things change. Brands like Apple, Tesla, and Amazon totally nailed this cycle by rolling out products that shook up industries and changed how people shop. They don't just stash away cash. Their success comes from regularly providing products and services that really make a difference in people's lives. All right, legends, that's a wrap for today. If you got even one golden nugget from this video, smash that like button, subscribe, and hit the bell icon so you never miss a money move. Got questions or want more content like this? Drop a comment below, I'm always reading. Until next time, keep grinding, keep growing, and I'll see you in the next one. Peace, success, and passive checks.